You're about to join Niels Kostrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Alan, Dunne and I, Niels Kostrup-Larsen, where each week we take the pulse of the global markets through the lens of a rules-based investor. Alan, it is wonderful to have you back this week, which has been pretty busy if you're a Fed watcher. How are you doing?
Yeah, good to be back on. It's, as you say, it's been a busy time in markets, a lot of moves, particularly big moves in equities if you're in technology stocks. So it's certainly interesting times.
Yeah, it's funny. We always say it's been, a busy time, but it seems like it's just always busy, or at least it has been for quite a long time. Now, we got some great topics that you brought along. And, as usual, before we do that, I'm always curious to find out kind of what's been on your radar and kind of what's your big macro picture at the moment.
Yeah, well, as you say, it was the Fed was the focus this week. So I think that's really, the interesting thing. We had their latest statement of or summary of economic projections, and I just thought it was interesting that they've slightly raised their forecast for growth in 2023, lowered their projection for unemployment, and raised their forecast for core PCE, and obviously raised their dot plots again with an expectation of a couple of more rate hikes now. So it's just interesting. We're 15 months into a tightening cycle. We've had 500 basis points of rate hikes, and there you have the Fed kind of raising rather than reducing their expectations for growth. So I think that's interesting. And if you look at how they've adjusted the dot plots, they actually have raised their expectations for kind of the year-end rate for the Fed funds for this year and next year. That's been raised at every meeting except March of this year, when we were in the midst of the banking issue. So it's kind of very much a moving target. But it does beg the question, we've had all of this tightening. Where's the slowdown? And, if you were to go back to the back end of last year, there was always, almost a pervasive sense that recession was imminent, and I would have held that view myself. So I think it's interesting, what's the explanation for this? I think that's one thing I'm thinking about. Obviously, monetary policy, respond, or the economy responds to monetary policy with a lag, and those lags are long and variable. So it could be that we're just still in the midst of that process of it impacting the economy, and we'll see the slowdown later on. I mean, a second possible explanation is economists talk about the transmission mechanism of monetary policy. So that's like, what is the chain of events that translates from higher rates into slower growth? It's typically borrowing costs go up and people cut back on their borrowing, or they save more. So is there something around that may have changed? And that's possible too. I mean, I think obviously a big story has been the excess savings that people accumulated during the COVID crisis. And there's one estimate from, I think, the San Francisco Fed, I read during the week, saying that there's still, $500 billion of excess savings in the US economy, and it'll be, probably the next year before that kind of run down. So that's something that's possibly blunting that transmission mechanism. Fiscal policy is still accommodative. The US is running a budget deficit of about 5-6%, even at full employment. So that's a support as well. And you've had, some other structural tailwinds for growth in terms of, with the I suppose the nearshoring trend, more factory construction, things like that. So I think they're all factors which have kind of blunted that transmission mechanism. And also, financial conditions haven't really been tightening for a while. 10-year yields, 3.5%, 3.75%. So, it does beg the question, although short rates have gone up, we've had this very inverted yield curve. Do you need to see higher long-term rates to really see the economy slowing down? So I think that's another factor as well. Obviously, in a downturn and the Fed brought rates to zero, the whole point about quantitative easing, all of those policies was to try and bring long-term rates down, because the view was that was the key rate that would influence the economy. And now they're raising rates, but they're not getting that key long-term rate up. So I think that's another factor that's behind, this more blunted response to higher rates. So overall, yeah, I mean, the theme at the moment, there have been some signs of a slowdown. Jobless claims have crept up a little bit, but still, I would still expect at some point we'll see a reaction to higher rates, but the question is the timing, and that's the difficult thing. Markets are obviously behaving like it's Goldilocks again, and everything's going to be okay for as far as the eye can see.
Yeah, no, I mean, a couple of thoughts on that. I mean, first of all, you mentioned the Goldilocks, and of course, I mean, it is a very, very narrow rally if we turn to kind of the reaction we see in the equity markets, and that's can be of some concern. I think the Russell 2000 actually hasn't moved that much, and certainly not near its all-time highs compared to some of the other indices. So I think that's an interesting thing. I wonder whether you see that as a little bit of sign of risk somewhere in that. The other sign I would just mention, not that I want to be an alarmist, but I did notice on Friday that the VIX just slipped below 13.5, which I believe is the lowest level since the 14th of February of 2020, when the VIX hit 13.38. And of course, that happened to be 2 days before the S&P hits its high, before the incredibly plunge into the lows of March 23rd, 2020 due to COVID. So I mean, it might all look great on a Friday or a Saturday morning for you and I, but you just never know what's around the corner.
No, for sure. And it's interesting, the last time I was on with you here was at the end of April, and markets had been kind of stuck in a range. We were commenting about how the S&P had been trading around 40-50 for a long time, and I think it was just under 4,200 at that stage, which a lot of people had been looking at as a key technical level and probably the level that would hold. But obviously, since then we've seen a break to the upside. The S&P is up about 6% since the end of April, but the Nasdaq's up about 17%, and it's up 30% from where it was at the start of March. And as you say, breadth has certainly been an issue. The Russell 2000, it's jumped up a little bit in the last couple of weeks, but by and large, it's been flat. European equities had a run up at the start of the year, but they've kind of turned flat as well. Obviously, Japanese equities have been doing phenomenally well, but it's kind of like we've had this rolling rally. If you went back to last December, it was more like the industrials and materials that were moving, but that, as we say, that's kind of stalled out. Now it's very much focused on technology, and it feels like a classic trend move. It feels like you'd have to say rising prices are now influencing sentiment. It's such a persistent move up. Like I think, the Nasdaq closed slightly lower yesterday, but it had been kind of 6 or 7 days in a row. And I saw a statistic in that the volume of call buying on the S&P was at an all-time high. So certainly it feels like a bit of a FOMO move, fear of missing out. Is it a bubble or not? Yeah, we both will have our views on that. But at the moment, it's a trend, and that trend is influencing sentiment, and fueling further buying.
Absolutely. It's influencing sentiment. It certainly also influenced performance of trend followers. But before we get to that, you mentioned one thing about this, savings were, pretty high and healthy. And I just wonder, I mean, clearly Powell wasn't too happy about the PCE, even though it's coming down. It's still like twice the level they want to see it at. And I wonder whether this, high level of savings combined with a 5% interest that you suddenly get actually spurs more spending, meaning suddenly people can spend more money, and especially in the service sector where you are starting to see, certainly higher wages come through, et cetera, et cetera. I mean, it's not an easy job to be a Fed official, that's for sure. And it's obviously very easy for us to criticize some of the things they've done in the past, which I'm sure we'll continue to do. But still, it is as we often say, it's a complex adaptive system we're operating in, and therefore these effects are important. I couldn't help noticing some of the headlines. I don't know if you pay attention. Normally I don't, but someone had summarized some of them for me. But in the last 10 days, in some of the mainstream media, June 8th, CNN, it's official, we're in a new bull market. Barron's, June 8th, don't fear the bull market. Why stocks are heading higher? June 10th, Yahoo Finance, new bull market has legs. The bear market is officially over. And then a couple of days ago, Market Watch, the bulls finally control the stock market and the signs are pointing higher. Yes. So, I mean, what could possibly go wrong with those headlines?
Yeah, exactly.
Right?
It's the classic, all we need now is the economist to come out and say there's a new bull market in equities, and it'll be a clear sell sign. But you're right. I mean, it's interesting. You touch on the higher rates, and I think there are so many factors, and that's why these lags with monetary policy are so variable and uncertain, because it depends on the demographic composition of the economy as well. If you have a lot of people who are, maybe if you have a larger, older population, people will maybe save more and they benefit from the higher rates. And obviously the other point is, people locked in lower rates after COVID, particularly with respect to mortgage rates in the US. Obviously, you're starting to see in the UK now, mortgage rates are adjusting and people are scrambling to lock in rates. Yeah, I mean, and most of the econometric models are kind of, at least my understanding is, they're kind of based on kind of broad sensitivities. Historically, if rates go up X percent, how much does that impact on consumer demand? But obviously that doesn't account for the fact that the composition of the workforce and in terms of demographics and inequality, etc., will change over time. So it is very difficult. It's an almost impossible task, but that, as you say, we'll probably continue to criticize and point out their failings over time.
What else should we be doing every week? Now, kidding aside, I mean, just final point before we jump to the trend following and all the great topics that we're going to discuss. And, although I have lived in Switzerland for a very long time, I do probably follow the Danish economy a little bit closer just because I watch the news there. And it is interesting, and I wonder whether this can be applied to many other countries, because I think we're all a little bit surprised when we see the resilience of the economies. I mean, in Denmark, they have more people ever employed in history. I mean, never have so many Danes been employed, let alone having a very low unemployment rate. But I was just speaking to a friend of mine this week, and he was saying, well, that one of his sons had got a new job. He's still young. I think he might just be finishing his master's right now. But he was working in HR. And for I think it was I can't remember what sector he was in. Could be medicine, I'm not sure. But anyways, or pharmaceutical. But he was saying this company alone was going from something like 20,000 employees to 40,000 employees in the next 3 years. Not just all of them in Denmark, but it's just when you hear numbers like that, the plans of expansion, and maybe, as you rightly pointed out, I mean, obviously the onshoring perhaps should not be underestimated in terms of what's going on. We've obviously seen some pretty weak numbers out of China compared to what people have expected. So maybe things are just shifting, and then obviously combined with the demographics, maybe we're just all sitting here using old style sort of measures and missing some of these underlying currents that sometimes can be quite hard to detect.
Yeah, no, for sure. I mean, it's interesting you're talking about job growth. I mean, the theme that I've been picking up in the last couple of weeks has been more about concerns about all of our jobs, that we won't have jobs in 5 years' time because of AI, which is, that's the other side of it, which
we'll talk about very shortly. Yeah, exactly. All right. Well, let me just quickly run through the trend following side, because it wasn't just the stocks that had a great week. Trend follows did as well. And what's really interesting about this is that I think a lot of investors focus on trend following from a crisis protection point of view, the ability for trend followers to make money when equity markets are having a difficult time. This week and the last few weeks has been a really good example of the ability of capturing trends during times of optimism. So that's kind of great to see the other side, because as we know, it's only a few months ago when trend followers were doing well at a time when equities were struggling. Now, the losing team this week was clearly the commodities, not from a price point of view, but actually from a trend following point of view, because a lot of the downtrends in commodities came under attack due to this wave of optimism that we're experiencing. And so we did see some money being given back in the commodity sector, but all was not lost because there were a few commodities that enjoyed some positivity, especially in the soft sectors, where we had a particularly sweet trend for sugar to the upside. Now, the real winners this week was really the financials. Equities were charging ahead, and trend followers, as has been publicized in some of these articles a few months ago about how trend followers would be triggering buys into further equity prices moving higher. Well, we certainly have been long for equities for a little bit now and are enjoying some of those up moves. We're also enjoying still continued short exposure in fixed income, even though it's not moving significantly. It's still moving in quote unquote the right direction for trend followers. And then currencies, they seem to sort of still find some inspiration in the Mexican peso and the Japanese yen. Now, my own trend barometer continues to close in the neutral to weak level, most likely because the parameters I use in the trend barometer is on the shorter term side of things. And if we just go through the numbers, people will also realize that actually shorter term strategies have struggled more this year than the longer term. So speaking of which, BTOP 50 up 45 basis points as of Thursday, down 1.25% for the month of June. SocGen CTA index up 0.5%, down just shy of 1% for the year. Trend index up 0.5% as well, down 1.5% or 1.4% for the year. And the short-term trainers index putting in 39 basis points so far in June, but still down almost 3% for the year. Now, of course, stocks doing really well, up almost 6% in both the MSCI World and the S&P, and up double digit for the year, 13.8 and 15.8 respectively. Bonds are losing a little bit of ground this month, as you would expect with these statements coming out of the Fed. Now, Alan, you already alluded to that we have actually some pretty varying topics today. The first one is certainly out of my comfort zone, so I'll be guided by you. It probably is out of most people's comfort zone in the sense that we don't really know what we're dealing with here. But then we're going to bring it back to some trend-following stuff. Great paper from Katy Kaminski. We're going to revisit maybe briefly some of Quantica's findings, but also you've been in the archives this week, my friend, because you have been digging out some old papers from Transtrend, which will be fun to see what your findings are. And then, of course, a last topic we're going to talk about is risk management, which is really important in everything we do. So, Alan, AI, the economic potential of generative AI, the next productivity frontier. What's that all about?
Well, you're right. I mean, I feel equally out of my depth on AI as well. But I mean, we've been talking about equity markets, and it's just, I mean, it seems, obvious to say. I mean, I think AI has been a big theme here and a big influence. And I think if you look at the performance of the NASDAQ in the last few months, you really get a sense of that. You know, as I say, up 30% since the start of March. You know, what's happened in that period? Well, firstly, you had the banking crisis, and there was a lot of liquidity injected into the market, so stocks went up on that. But then, obviously, we got over the banking issue, and seem to have for the moment, and yields started to rise. So notwithstanding what I was saying, that yields are not that high, but they are higher than they were at the start of March. And normally you would expect to see the NASDAQ to struggle in that type of environment of higher yields. But we've seen a disconnect in that relationship, because obviously technology stocks are kind of long duration assets. Their cash flows are far in the future. So typically a higher yields is a headwind for technology stocks. And equally, I just thought it was interesting in the last few months, you've seen a disconnect between technology stocks and crypto, whereas if you went back over the last 2 to 3 years, they tended to be quite highly correlated as kind of speculative assets or positive growth. But we've also seen a disconnect there. So I think the factor that has really propelled obviously technology higher has been AI. So that's kind of prompted me to look into it in a bit more detail. And it was interesting. McKinsey had a paper out this week talking, as you say, about the economic potential of generative AI, which is quite an interesting read. It's very upbeat for the long term. And what they've done in this paper, if they've looked at kind of 63 use cases of generative AI. So this is kind of basically kind of like ChatGPT type functions, where the machine is able to generate that kind of content and responses and understand language. So they focus on these 63 use cases to kind of get an estimate of the economic impact. So just to give you a sense of some of the highlights, they estimate kind of between $2.6 to $4.4 trillion annually of benefit. So, that's a decent sized number. To put in context, US GDP is about $26 trillion. So it's, fairly meaningful impact. They're saying that a lot of this technology could automate between 60 to 70% of tasks, particularly for knowledge workers. And they were saying that knowledge workers, so kind of white collar workers, typically spend about 20% of their time searching for and gathering information. So these are the types of applications where they think there's the real benefit. And the focus on kind of four main areas, kind of customer operations, so I guess interacting with a robot, which we're obviously starting to see that in lots of cases, but more and more of that. But equally assistance for a human in that regard. And they mention how Morgan Stanley are building an AI assistant using GPT-4, basically to help their wealth managers respond quickly to client queries. So somebody, I guess, could have a question on the market, and you would consult with your internal GPT-4 tool to get a quicker response. So the other areas, marketing and sales, so even content generation potential there, obviously software engineering, writing code, and R&D. So even kind of generating content are all the kind of areas of possible benefit. And from an economic perspective, then they say this could increase labor productivity by between 0.1 and 0.6%. So that's pretty important because, economic growth, there's two factors that determine growth over the long term. One is population growth and the second is productivity growth. So if you can get that kind of higher productivity, it's obviously very important from an economic growth perspective. So they were the highlights of the piece. Obviously, it's talking about these benefits coming in the future. Now they do say, they kind of say like half of activities could be automated between 2030 and 2060. So it's that kind of time frame we're talking about. It's not necessarily this year or next year, but certainly over the next kind of couple of decades. So it kind of got me thinking about, okay, so that's the kind of the expert view on how this is going to play out. So what should we see from that perspective in terms of the markets? And obviously, as they say, it's going to be enhancing productivity. So, from an economic perspective, that's what you would call an outward shift in aggregate supply. So basically, it should be disinflationary over time because we can produce more with fewer resources. So that's a positive. Obviously, who's going to benefit? Well, you would say it's the owners of capital should benefit because they can get workers to do more with less. So that should be good for margins and obviously good for growth. There are risks associated with and challenges associated with this. Obviously, if you have fewer workers required for certain tasks, people will be displaced. So then they have to be retrained. And you could have tensions around that, obviously, to the extent that AI leads to higher unemployment. In theory, then those resources can be redeployed elsewhere, which is true. But in the short term, you could have tensions around that. And how do you manage that? How do you retrain that? How do you retrain people? So I think that's an interesting thing. And then obviously you have the whole area of the risks and the threats and the misuse of AI as well. So that's a potential negative. But it's interesting when you think about that versus what we're seeing in the markets. What we're seeing in the market at the moment, it's very much focused on where is the spend going to come from, that like who's going to immediately benefit from this. So it's kind of the chip makers, the likes of Nvidia. In theory, banks are going to benefit as much from this, but we're not seeing a big run up in banking stocks on an AI boom. We're seeing, what we're seeing is obviously, I suppose the business is closer to where we might see potential spend, but obviously, and stocks like Nvidia trading at 40 times sales. So there's a huge amount of kind of expectation and optimism around this. But so the question really is, will that IT spend come through or not? So I think in terms of assessing, is this a valid rally in these stocks or not? And, it's an open question. Of course, we're going to see a structural tailwind there, but that's not to say we can't see in a downturn, what happens in an economic downturn. The first thing that gets cut back is spending on IT and software and stuff like that. So it does feel like people are looking at this broad macro factor, which is obviously going to be a big important driver for the global economy over the next number of decades, but translating it into a very specific optimistic view on a certain number of stocks. Will that be proved to be the case, proved to be too optimistic or not? Hard to know. But you could have a scenario like we had in 2000 where, yes, the development of the internet was transformational, but that's not to say that those stocks weren't overvalued at that point. And, we could certainly see something similar at this time around.
No, I think that's a great point. And there's so many thoughts about this, and I'm certainly no expert in this. Interestingly enough, next week on Wednesday, we're going to publish our first episode in a new series that we call Galactic Macro, where we're going to touch on some of these a little bit out there type of topics that's being revealed at the moment. But it does link to AI, in my opinion. And I remember the first recording we did with a young guy called Jay Anderson. And one of the comments he made when we kind of touched on, and I say we, it's actually a guy called David Dorr who's hosting this. But when they were talking about AI, I remember Jay mentioning that he thought that with AI, this is different. Because it's out in the open, open AI is obviously very much front and center with ChatGPT. He was very concerned about people investing in this, putting a lot of money behind it, because he thought, and I hope I'm not misquoting him, that things are moving so quickly in the open AI space that it's moving faster than any of these companies individually can kind of keep up. Now, I'm not talking about Nvidia specifically. I have no idea what they really do, and maybe they're the only ones who can do what they do, so to speak. But I kind of see that. You kind of see how much progress and how many. If you just look at your Twitter feed, I don't know about you, Alan, mine is full of. Suddenly, it's all full of people who are talking about AI. It certainly wasn't usually like that. So, it's super fascinating. I think it's scary to some extent. One of the things that also scares me a little bit about it is the fact that I'm not so sure, if we look at the global population as a whole, that there are that many people who are really paying attention to this for obvious reasons. We don't all have computers and iPhones and so on and so forth. And so I wonder how people will react if some of these things starts to work. Now, you did mention this thing about robots, and all I can say is, if you ever tried one of these robots that tries to help you on a website, like a support robot, I think they could use a little bit of help, frankly. That is not a great experience, in my opinion, when it keeps asking you about questions that you didn't even, that you're not interested in. So maybe there is a little bit of an upside to improved AI somewhere. Anything else that you wanted to talk about this particular thing? By the way, maybe we should turn it a little bit to the trend following space. Just touch on that.
But even beyond, more broadly, there was an article in the FT yesterday, I think it was, just talking around how this is presenting. Obviously, we in our space we know about machine learning for some time, but other strategies might be using it to read like Twitter feeds, and they were talking about how, I think it was a month ago, there was a generated a fake explosion of an image of an explosion. I think it was in the Pentagon or something like that. That prompted a sell-off in the S&P 500, which I hadn't been aware of. But it's kind of these kind of things that if you can use AI can generate fake content that looks valid, and then you have models that are basically, scraping the net, looking for news sources, etc., and responding to that. That you can have that. Obviously, that's a challenge for those types of trading strategies. So it opens up a whole host of different things. Obviously, from a trend perspective and the use of machine learning, which is AI. We've been aware of this for some time, and it is a topic that came up on our CTA series, and I can't remember who it was, but it was certainly struck with me. There was a comment from one of the managers that the people who were most expert on AI were most pessimistic about its application in financial markets, whereas the people who were more less expert were more optimistic. So it was something that in the CTA space, maybe going back 3 or 4 years ago, everybody was kind of focused on machine learning, and if you had a machine learning program, it seemed to be it was going to solve all trading problems, but it hasn't proved to be the case. And one of the papers we'll talk about now in a minute is around the perils of machine learning, basically, or overfitting or overlearning to a particular environment. So, yeah, I don't think it's going to put people in the investment management world out of business yet. But what do you think?
Well, I mean, I think just to round that off before we move on to that paper, I think it's worth knowing, and this is really what makes me so, give me so great conviction in trend following as a strategy, and that is that this really is a strategy. And of course, I've worked for a firm that has lived this for almost 50 years. We have gone through so many quote unquote revolutions in the markets, right? The internet came, and that was going to change the world, even for trend followers. Then the technology revolution came, and that was definitely going to change everything. But trend following continues to do what it does, and it continues to deliver. It's incredibly consistent once you zoom out in terms of its long-term returns and risks and drawdowns and all of that. So I actually don't think it's going to make a beans of difference. And I know that's a statement that you might come to regret at some point, but I actually don't think it's going to make a big difference from our point of view. Because if you think about what trend following really does, well, even if AI could help make predictions about the future, and I think I may have mentioned this before on a previous episode, even if it could help you make predictions about the future of a market price and say, oh yeah, but corn is going to move from 600 to 1,000. Okay, well, it's going to go to 650 first, and then 700, and then 750. And those moves are the ones that simple trend following systems are going to pick up and going to position itself for. So AI or not, I'm not pessimistic about its impact on trend following. I think we'll be just fine. There's so many other things that could impact the financial world in a negative way. But even trend following, when you just think about what happened in the last kind of couple of decades, where you essentially had central banks keep interest rates at zero, and even negative in some. I mean, that's another extreme event that we had to cope with. And we did. We just found opportunities in other markets as well as in bonds, which actually leads us to the next conversation, which is beyond the bond bias, which something is Katy Kaminski and her research assistant wrote about over at Alpha Simplex. So why don't we just dive straight in?
Yeah, it's an interesting paper that Katy and our colleague Yingshan Zhao have produced around long bias in bonds. So the overall, I suppose, idea here is that, I think obviously we had a big sell-off in bonds last year, but that came after a multi-decade rally in bonds. So the question that they were investigating was, had that kind of prompted some managers to build in a bit of a long bond bias into their systems. So what to do is to look at the 10 largest trend following managers in the US mutual fund space. And they also look at the SocGen trend index, and they also have their own kind of representative trend following system. And so then they kind of estimate the bond beta of all of those programs in the index over time, and then compare that versus the representative trend system to see if any of the managers seem to have less of a bond exposure than you might have expected from a representative system. So what you do find is quite a bit of dispersion, as we always expect. Even at the end of the year, one of the managers was showing a positive bond beta versus all of the others being negative, and then there was the usual large spread of, like, at times, for some managers, the bond beta was maybe in excess of -1, whereas others it was like -0.2. So quite a bit of dispersion as we often see. So what to do then is kind of try and examine, well, why might this be the case? They look at the SocGen CTA index versus the SocGen trend index to see, well, is it more kind of a phenomenon of the for diversified managers, but they actually find a pretty similar outcome between the two indices. One thing that they did, which is quite interesting, they said, well, what impact would it have on the representative trend system if you limited your shorts in bonds to 50% of the normal size that the system would signal? And interestingly, it showed that over the kind of the 21 years, 2000 to 2021, so 22 years, it would actually increase your performance of the system, but then it would cost you about 7% in 2022. So I thought that was quite an interesting outcome, because if you think about it, if you come up with a strategy and it does boost your return over a long period of time, it's easy to see why people might say, well, this makes sense. Like 21 years is quite a long time. Why don't we do this? And I actually do know of some managers for philosophical reasons who don't short bonds at all. So that's certainly a possible explanation to it. I guess the main thrust of their argument is that maybe is it that people just learned on a particular environment and got conditioned to have less shorts in bonds, and they show this by basically applying machine learning to the bond data. So they look back and say, if you were to apply a simple kind of 6-month moving average signal to bonds, and if you were to do that from the last since 2000, they do it from 1980 actually. So what would be the optimal trading strategy? Just using the 6-month moving average, you could be long or short. And actually, what they find is, if the moving average is negative, you're long, or if it's positive, you're long. So you're long always. The only time you kind of reduce your position is when the moving average is very positive. So the market has kind of got overextended. So basically, if the 6-month moving average is very negative, you're buying because you're expecting, it's a buy to dip type strategy. If the moving average is positive, you're also long because of momentum. But if it's very positive, you actually cut back your long and you have a slightly less long position. So that's how the model would have learned to trade the bond market. If you just look from 1982 to 2021, obviously that wouldn't have worked out very well last year because bonds went down the whole year. So the interesting thing then is you add in the data from 2022, where we have the sort of model then can learn on a period when bonds are going down. That does impact it a little bit, but still you didn't really have many instances of being short. So I thought it was interesting that even, we sometimes think about, well, machine learning will learn on the new environment. But even with that, an environment where you clearly would have learned about bonds going down, it still had this quite a notable long bias in the system. So what it did then was quite interesting. They then look back, and if you were to apply the data on the period 1962 to 1982, now obviously we didn't have bond futures back then, so what you have to do is basically estimate what the bond futures would have been. You can do that based on the yield and the change of yield, etc. And it's interesting, the optimal trading strategy for that period, you would have always have been short bonds. So if the moving average is very negative, you're short. If it's slightly less negative, you're even more short. Even if the moving average is positive, you're still short, because bonds tended to go down in that period. Obviously, in the 70s, you had a big bond bear market. Yields went up to 18, 20%. So the system, if you were coming up with this machine learning system in 1982 and about to trade the markets, you would have got run over, because the system would have been always short bonds. So the final bit, which is quite neat, when you combine it all together into looking at the full period, 1962 to 2022, and run the machine on that to see, well, what's the optimal trading strategy based on the 6-month moving average, it looks actually very similar to what you would get with a trend following system. So when the moving average is very negative, you tend to be short. As it's less negative, you tend to be less short. When it's positive, you tend to be long. And when it's more positive, you tend to be longer. So it's a very neat, the paper was a very neat way of showing, one, the pitfalls of machine learning, and two, that actually, a trend system is probably the most robust way of approaching it, as evidence from a really long-term data set.
Yeah, no, I like that a lot. And obviously, speaking from our experience, if I wear my Dunne hat, I mean, we did trade through the 1978 to 81 period where yields went up significantly. And that certainly was a very profitable period for trend following, without a doubt. But I've mentioned before on the podcast that I do believe in these cycles, market cycles, that Howard Marks also write about. And so for me, what we've seen in the last couple of years may really only be the beginning of this new interest rate cycle heading higher for a number of decades, not in a straight line. But if you believe in that, and so I really think that the paper, in a very nice way, illustrates the dangers of these things, and experience can't be back tested, and this is why, to some extent, even though I don't really want to. I do think it's nice when you have new people coming into the industry with new ideas and all of that stuff. But I do think there is something in our industry to be said about firms that has very long track records and have had these experiences, because it's one thing and maybe, I don't know, I'm sure we have a little bit of time for, how potential biases can creep into a system unintentionally. For example, by adding new systems or by having filters, et cetera, et cetera. And I think this is some of the dangers that if you don't have a long enough experience and you've only experienced kind of one environment, you might be unintentionally tempted to include stuff that really just works in the period that you personally experienced. I know we do backtests a little bit longer than that, but you still might be influenced by your own experience. So I think this is very interesting. And it kind of reminded me, before we move on to the next papers, but it kind of reminded me, Alan, about one of our conversations in the CTA series, which was Roy Niederhofer, because he wrote back in 2013 or 14 this paper where he basically said, well, trend followers are going to be doomed when interest rate starts to go up. The only way to deal with this is being short term. And of course, 2022 comes along and that doesn't hold true. And so when we confronted him in a friendly way, of course, his quick answer was, well, I didn't expect the yield curve to invert. So meaning that the roll yield was not as bad of a headwind as he expected. But I think we would have made money even without an inverted yield curve from what happened last year. So in any event, having no bias and all of those things, I think is pretty important. Even though I will also stress, and this is not just for bonds, but you and I also spoke with Brian Proctor recently from EMC, and he did say that they have a long bias in their models across all markets, and that had helped them. And we know that from research that long side trades in trend following tends to do better. But I'm not sure whether that's influenced by the fact that we've had mostly long-sided trades in fixed income, mostly long-sided winning trades in equities, maybe when you take the big chunk. I don't know this, honestly, but I think it has that there is some link to that.
It's not necessarily that it's good or bad. You could, as I say, I've come across managers who don't short bonds, and they say, well, they don't want to be short what they perceive to be a safe haven asset because you can get in crisis spikes higher, and that's fair enough. I mean, if people make that choice, that's fair enough. And then you will know that in an environment like last year, obviously they won't capture that kind of move. I think as you say, the challenge is if you are doing lots of back tests and you find something that works over 21 years, you might easily say, oh, this seems to be something valid, but you could actually be just picking up a bias inadvertently. And we certainly got that in a number of conversations in terms of, at Russell at Mann had mentioned that how they have to manage researchers and oversee them, that's where the experience comes in, where you look at a system and say, well, actually, you may be trading these markets, but actually what you're picking up on is a strategy that works in an environment when yields are falling and won't necessarily work when they're not. And you see that, I certainly saw that, in possibly more in the short-term space. You saw certain strategies that worked in the QE type environment, and then didn't seem to work out after a period of time. So I think it can, as long as you know what you're doing, that's fine. I think the challenge is if you have some bias that you've picked up inadvertently and you're not aware of it, that's where it's problematic.
Yeah, and then giving it to an AI where you have no idea what it's doing, I think that's a recipe for disaster. Anyways, moving on. I don't know how much you want to talk about the Quantica papers, because Nick and I did some of it last week. But feel free. And then, of course, we have the Transtrend archive, so to speak, where we're going to be speed skating. We're going to be talking about instability of VAR and also the importance of robustness. So feel free to jam
the
here.
Quantica paper was a starting point, because I suppose the Quantica, the Transtrend papers, and they all lead into kind of a general kind of discussion around risk management. But firstly, the Quantica paper was about when trends end in a rush, and it's all about how, it's kind of a review of what happened in March. Obviously, in that period, with a big reversal in short-term interest rates, it was a very tough month for trend followers. SocGen trend index was down 7.7% on the month. So they review that to say, looking at a representative trend system, basically, was it the right thing to do in terms of having so much risk concentrated in fixed income? And based on their representative trend system, they estimated that, fixed income accounted for about 85% of portfolio risk at that time coming into March. So obviously, you'll remember, I think at the start of March, Powell kind of alluded to possibly 50 basis points. So everybody got bearish on fixed income, and the market moved that way, and trend followers would have increased shorts. And according to Quantica, in their representative system, the system was short across all 23 contracts. And then obviously we had the trend reversal. So it wasn't actually a massive short. In terms of 10-year equivalent, they estimated about 135%, which, relative to the kind of long positions you would have seen in bonds, during the bond bull market, that's not that large. But obviously what we did see was really extreme moves, particularly at the short end. So like the moves in, I think, the 2-year yield were the largest we've seen since 1987, since Black Monday. So it was more of a case of really extreme moves. But the big question, would you have been better off if you had kind of reallocated the risk away from fixed income to more of a broad kind of lever up the other side of the portfolio and downweight fixed income, even though the trend opportunities didn't seem to be as evident? And they find, yes, you would have benefited in March by doing that. Now, other markets did reverse as well, so you would have only benefited. I think you would have reduced the loss by about 4%, but you would have only gained. They estimate that the overall SocGen trend would only have gained about 6.5% in 2022 by taking that approach versus whatever it was, 27%, I think it was. So basically saying, yes, if you did take that approach, you would have done better in March. But I suppose if you think about it, some of the best periods for trend following tend to be when you get your risk on and the trend extends. And, we only have one version of history. So there could have been a version of history where Silicon Valley Bank didn't blow up in March and the Fed did 50 and the trend continued. So, it's just, that's the way things played out. So their perspective is that this is just a part of trend following. You will get these short reversals. Trend following programs respond. They respond to the vol. They'll cut the risk, and that's just part and parcel. That's the kind of the trade-off that you're getting, those uncomfortable periods in return for the risk premia that you pick up, if you want to call it a risk premia, from trend following. So I thought that was interesting. It did get me thinking. I know Transtrend. We've had Harold on Top Traders Unplugged, and he talked about kind of a different approach, I guess, and I was went back through some of their previous articles, and it's very much around for example, they don't. When we spoke to Harold, he said they don't use stops, and that was controversial when they were starting out. So you might say, well, is that a good risk management technique or not? You might say, oh, that's a bit loose from a risk perspective, but obviously they've been doing it for many years, and now lots of managers don't use stops. So it's not. My overall thought on this is, what constitutes good risk management? Is it necessary to kind of downscale in risk in those kind of short, sharp shock environments? And as you've alluded to some of the Transtrend papers, I'm not going to go into them all, but the ones you've alluded to kind of give a sense on their approach, which is, I suppose, they're different in a couple of ways. One, they don't use maybe the same volatility estimate that and vol measure, they say, as other managers. And they're very much trying to differentiate, as they say, between a reaction and a trend reversal, which is obviously quite difficult to do. But that's kind of the philosophy of maybe not overreacting to these short or these kind of sharp counter trend moves. So I think it's interesting that we all kind of talk about rigorous risk management, and all managers will say that. But actually, risk management and managed futures is probably a lot more subjective than we might think at first instance. Like, there's a lot of areas where people will differ in views. So just obviously, on a trend reversal, how you respond to that. You might find that actually if you could come up with a strategy that actually goes against that when you get a reversal, that's actually a good opportunity. So would that, if you found that, a kind of a mean reversion strategy, would that mean you shouldn't cut your risk when you get these sharp reversals? The use of stop losses, that's another one where people have different views. Which vol measure? What kind of look back is the right look back? So for example, in 2020, if you had a sensitive look back on your vol measure, maybe a more of a longer term vol estimate, the spike in vol that we saw in March might have kept you out of equities for quite a long time, or might have really constrained your ability to go long in the equity recovery. Whereas if you had a much shorter estimate, as that kind of period rolled out, you would have got back into the equity market again. And then also, if you think about the 2020 period as well, the COVID, some managers stopped trading that period. So was that prudent risk management or not? Or was that a period when you should have been trying to harvest a risk premium? And then you have the general issue around intervening around certain events. So, some managers will downweight risk going into events like Brexit, or if there's an election or a referendum. And then there's the whole topic of, reducing risk in a drawdown. Some managers make a virtue out of saying, if we're down 5%, we're going to cut risk by 10%. If we're down 10, we're cutting risk by 50. But, and another of the Transtrend papers is around fast skating, or basically you have to maintain risk in a drawdown to have the ability to come out of it. So as I was thinking about all of these things, it strikes me that it's very easy to kind of identify, poor risk management. We can all say, okay, SVB Bank, they left themselves wide open there. And there's easy things you can do from a risk management perspective. Obviously, mitigating counterparty risk, things like that, diversification, anything where the benefit is obvious and the cost is not high. But it's when you have something that there's a trade-off, or you're giving up something. So obviously, if you reduce your vol or your leverage in a drawdown, you are giving up the potential, a bit of a potential return there. So is that a good thing or not? That's where it gets a lot more subjective. So yeah, I'm curious to get your thoughts as well, because it just struck me as I thought of all of these different ways that are quite subjective. Basically, we tend to think about risk management as a separate part. The alpha generation is first, its risk management is separate. But the risk management really reflects so much about the manager's tolerance for risk, their philosophy about what kind of risk they're going to take, and that it really is as much of the alpha generation as the signals themselves.
No, I think that's a very important point, Alan. And I think if I take a step back and just think about sort of my own experience in trend following, I think certainly in the early days, we were basically just grouped into, are you a long-term trend follower? Are you a short-term manager? And of course, it's really oversimplifying things completely. So I think one evolution is definitely this thing about, well, you can't really just look at a manager in terms of their look back, periods. That doesn't really it doesn't give you the full picture, because, and this is probably something that I've come to appreciate more and more, and even more so in the last few years. It's the reaction pattern of the risk management framework. I think that's incredibly important. Now, the other evolution you could say, and you touch on this, and we've certainly spoken about this, 100 times on the podcast, and that is this thing about, okay, so how do you manage risk? And I think in the old days we were again just focusing on doing trend following on a trade by trade basis, right? You have your entry, you have your exit, you have your, position size, etc. And again, we know, of course, that some of our friends who'll be listening today, that's still how they view the world. But we also know that many more managers are essentially incorporating and looking at this at a much more portfolio level, on an ongoing basis. And what is striking to me a little bit is that those people who have stayed with looking at these on a trade-by-trade basis, they will argue that, oh yeah, but it's about the sample size, and if you have trades that are not generated by a trend-following model per se, that sample size doesn't exist. Well, of course it exists. You have as much of a sample size in one approach as you have in the other. Absolutely. So I don't agree with that. I also find it a little bit intriguing in the fact that even managers who, again, do not want to look at changes in correlation, changes in volatility, still think that correlations are important enough because they choose a lot of markets because they're not correlated. Well, instead of looking at the markets, whether they're correlated or not, it actually doesn't really matter what their historic correlation has been. What matters is what's the correlation of your current positions. So I think that actually is something that is, again, a little bit of a, I don't know what the English word is here, but again, something to discuss, and something that differentiates us. So in many ways, I kind of lean towards the way it's evolved by looking at these things in more real time. But I will be the first to say that what the beauty of trend following is that you don't have to do it the same way to make it work. Now, I completely disagree when people say that the old school is better. There's just no evidence for that. So that's completely wrong to say that. But I'm not saying that it's bad. I'm just saying you can't say it's better because it's clearly not. There's no evidence of that in the data. But it is fascinating. And I think risk management, just to maybe round it off, is that I think risk management is perhaps some of the secret sauce that we never really talk about. And I think some of the managers that tend to excel over time are probably also some of the best risk managers out there. And so I think this is definitely an incredibly important part. I was wondering how you have seen the evolution of risk management from your perspective, looking in at many more managers than I've ever looked at.
Yeah, no, I think that's the thing. I mean, it's just everybody emphasizes it, that it's there. We've got rigorous risk management. It's in every marketing document that you see. But it does reflect different tolerances, as I say. And possibly, I guess you could say you might get different techniques for different strategies. So say, for example, the question around reducing, exposure in a drawdown. So as I say, some managers will say, if we're down 10%, we're going to cut our risk by X amount, and if we're down 20, we're going to cut, and maybe that's valid for certain types of strategies where you have some inherent concern about whether this thing will be persistent over time, but probably not for something like trend following, where you really want to have the risk on, after a prolonged drawdown, you're waiting for it. So if you delever that portfolio, when you get your recovery, you're not going to be invested. So it's going to be so hard to get out of a drawdown. So if you think about it, if you took that approach to trading the S&P 500, from a long perspective, every time the market goes down, you cut your risk. You're not going to harvest the long-term risk premium. So something that can sound like prudent and sensible actually can be, detrimental to counter performance. At the same time, all of the managers are basically trying to manage their risk of ruin, so it's like, what risk are you able to take? And risk of ruin in this sense is, having a performance profile that can basically put you out of business. That's what you're trying to manage, that you don't want to, so something could actually be optimal for the long term as well. And this comes back to, the vol scaling arguments as well. So people believe in that gives you the highest, compound growth rate. But others, and we certainly picked this up in the CTA series, will say, well, we want to be in business, so we still have to, manage the risk and manage the portfolio to deliver a return profile that will be palatable to investors. So that's an element to it too. And that's why you could get different risk management approaches, whether it's been driven by maybe somebody who managed their own portfolio and then morphed into managing other people's money, and they're comfortable with their vol and they're comfortable with that, whereas more of an institution could have a different approach philosophically, because it is around an investment business. So I think there's many layers of this to think about.
Yeah, no, exactly. And I think definitely good risk management versus bad risk management does show up in track records. I think that is for sure. When you start looking for it, I think you're going to find some differences. But I also think that those managers who are generally in these indices and have been around for a long time, I mean, there's a reason why they've been around for a long time. They probably all have pretty good risk management. They may not be the biggest in size. That's not what I'm judging it on. I'm judging it on, if you've been in business as a trend follower for 20, 30, 40 years, you probably have a pretty good understanding of how to have robust risk management. And that's unlike many other strategies we've seen come and go, or managers that we've seen come and go, where it all sounds great, but then, as Tyson says, you have a plan until you get knocked in the face, and so on and so forth. So I'm sure we're going to continue to talk about risk management in many ways. And I think, as I've said before, and maybe even today, I can't remember, that trend followers are first and foremost risk managers, because we don't control what the returns we get from the markets are going to be. We have no influence on that. But what we do is we influence the risks we want to take. And therefore, I really think that people will be surprised to learn that trend following is first and foremost about risk management. And that should give them some comfort. But just going back to what you said earlier, Alan, and this thing about, things can sound like common sense, but actually not be very good. Same with what we say. When we say to people, well, we're going to be buying the highs or we're going to be selling the lows, that doesn't sound like a very good strategy, frankly, because it's completely opposite what you've learned and heard, buy the lows, sell the highs. Well, actually, here's a strategy that does complete opposite and is perhaps one of the most successful strategies of all times over long periods of time. So yeah, you have to be careful. The narratives are important, and you have to be careful.
I mean, it's like,
for that.
Often people will say when you're trading, if the trade doesn't feel uncomfortable, it's probably not, not the right trade, So it's kind of like that as well. Things that ostensibly sound prudent, like managers in a drawdown. Okay, we should prudently remove this manager, but actually maybe the investment insight is, no, that's the time when you should be allocating to that manager. So I think there's a number of examples of this, as you say, things that seem prudent, but actually they're not the right thing to do from an investment perspective.
Yeah, absolutely. Anything else you want to add from these papers, Alan?
No, I mean, there's lots of, as we alluded to, some of the Transtrend papers, but and the Quantica paper is worth to read as well. So it's really, I think it's a thing. What strikes me, it's something that investors make up their own minds about which approach philosophically fits best with them, as opposed to saying, yes, this is good and this is bad. So I think that's one of the takeaways.
It's an ongoing conversation, no doubt, and I'm sure we'll come back to this over time. This was fun, Alan, as usual, and also very insightful, so appreciate that. And if you also like these conversations and the insights that we share, why don't you jump over to your favorite podcast app player and leave a rating and review, because they really do matter. These algos, the AIs behind Apple and Spotify and whatever they're called, they pick up on your reviews and your ratings, and it helps us move up the ranks. So please do that if you have a couple of minutes spare. Next week, I'm joined by Mark. So again, another interesting session, I'm sure. It'll be interesting to see what topics he will be bringing along. And if you have a question for Mark, you can email it to info@toptradersunplugged.com, and I'll do my best to bring it up at the right time. From Alan and me, thanks ever so much for listening, and we look forward to being back with you next week. And in the meantime, as usual, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.